You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Once again, thank you for listening. I appreciate it. I wanted to talk today about how the infinite banking concept was conceived. Now, this is a really cool story out of the book, Nelson Nash's book, Becoming Your Own Banker, which I talk about all the time. I just really like the little story, and I think it helps you to understand how he thought of this idea in the first place. How did he even think up something as amazing as the infinite banking concept that many are learning about and starting to understand the major impact it can have on their financial lives in a positive way? So I wanted to just share this story from his book as I slowly go through the book and kind of pick out things that I think will be helpful for your learning and things I want to point out for those of you that are reading and could use some extra insight or discussion on the topic, or just for those who might need to be inspired to check out the book and read it. It really is great. So first of all, Nelson says it's important that he had a background in forestry. So he was educated as a forester, and so that played a big part in how he saw things play out, because in the forestry world, you have to think many years into the future, for the trees to grow. When you're planting trees, it takes a long time to be able to harvest those and everything. So he worked as in that industry and then as a forestry consultant for about 10 years. He also was a successful life insurance agent. He learned at an early time how dividend-paying life insurance really works, and says that is absolutely essential. You need to have an agent or advisor who understands how the life insurance works in general. And I think a lot of people out there that are helping clients with different life insurance products, such as universal life, I don't think that they really do know thoroughly how the product works, or maybe understand the high risk of how the policy could lapse. And so it's important that your advisor understands the workings of the policy. Nelson said that most people have a very limited understanding of whole life insurance, or again, universal life, which I think even people have even less understanding of that product. And he says, including the people that work at the life insurance company. And that is for sure. So sometimes people will call in or reach out and say they reached out to some life insurance company and asked for help. I've said this before, I'm sure, but the people that you're calling in at the life insurance company, they oftentimes don't know what you're talking about when you're asking about infinite banking. And a lot of those people, even that work there and do different roles there, may not have a very clear understanding of how the product fully works. Now, if you're talking to an actuary, they know everything. But when you're talking to just client service people or different kinds of people that work there, they may not all have a very deep understanding of how it works. Just like any person with any kind of job, the people at the life insurance company have an understanding of their role and what they are doing at the company, what their specific role is, and how they help people or how they help the advisor. They're not necessarily, and I would say most, don't have really an understanding of how the whole life insurance policy works internally in general. They're just doing their role, doing whatever they were hired to do, and they're good at that thing, but not the inner workings of the policy. And certainly, just because a company may support the strategy or offer products that we use to help people with the infinite banking concept, they don't necessarily all understand what we're doing, how we're building it to be in your favor for cash value to accumulate, but rather they are there, each in their individual department, focusing on their specific role within the company, and they are good at that thing, but they have not studied how we're teaching people to use these contracts, how we're building them in your favor. So how this infinite banking concept was conceived, how Nelson came about writing his book. This book was strongly influenced by Nelson's background in forestry, his knowledge of how dividend-paying whole life insurance worked, and also his experience in the real estate business. He had actually been around real estate all of his working life and studied many books on the topic. He said that the message he received over and over from these books he was reading is that it's not really about the real estate, but instead it's about the leverage. He said these books he was reading were basically saying, buy a property, borrow the money to pay for it, pay the interest on the loan, and then sell the property. By doing it this way, you're only out the interest that you paid, and then the property is sold. It's out of your hands. You only had to pay the interest, and you were able to hopefully sell it for a profit, was the whole plan. And so this is where he states one of my favorite quotes: you are always dealing with borrowed money. You either borrow money and pay interest, or you use your own money and give up interest that you could have earned. In short, and like he always would say, is that you finance everything you buy. So Nelson had taken all the steps that were being promoted in books and that were popular at the time and certainly are popular now as well. And he was doing so well that he decided to expand his business. At the time, he was paying 1.5% over prime, and that was about 9.5% interest he was paying on these properties. And all was going great. He was doing great. He loved it. Business was booming. He was doing really well. But then the early 80s arrived, and with interest rates at that time, they really skyrocketed. So 1.5% over prime became 23%. Yikes. So very quickly, his real estate holdings became unaffordable. It became unaffordable to pay the interest only for a short period of time for the properties that he had. And during that very difficult time, some other large events were also happening within his family. He goes on to say how he then experienced a major burglary and that some thieves had broken into his house, him and his wife's home, and took a whole heck of a lot, cleared him out. So then just a couple of months after that catastrophic event happened, that was terrifying, his brother passed away. His brother passed away at the age of 52. And then just a short while after that, a grandchild was born, which was beautiful and exciting. But then not long after that, this sweet little baby was diagnosed with cancer. And he just couldn't even fathom the idea that a baby could be able to have cancer at such a young age. So he says that just one thing after another that was happening in his life, all during the time while he was trying to figure out how to get out of the financial mess that he had gotten himself into. He said that these things really had him up late at night into the wee hours of the morning, literally down on his knees in prayer, for asking for God to show him a way how to get himself out of this mess that he had created. And that's when it came to him. To put it in his words, he says, the answer to his financial nightmare came back about like a baseball bat across the eyes, telling him, you are standing in the midst of everything it takes to get out, but you don't see it because you look at things like everyone else. He realized then that he was actually able to borrow money at 5 to 8% from the life insurance companies through policies that he already owned, and that the only thing that was limiting him from how much he could borrow was how much he had paid in. The amount of cash he had in his policies at that time was not enough to take over the real estate debt that he had, all that real estate debt, but he did realize he would be able to if he just capitalized his policies with more premium. He said he was able to see this because he had already been paying pretty large premiums. And so that's how he was able to kind of see how he could get himself out of his financial bind. So the moral of these pages in Nelson Nash's book would be, don't be afraid to capitalize your system. Don't be afraid to fund your whole life policies well. The more you fund, the larger the pool of cash you will have. The more you'll be able to take over debts from other banks, the more opportunities that will find you for creating investments or cash flowing investments. I talk to people all the time who feel uncertain about how much to fund and want to start off pretty small when they have the means to actually capitalize on a much greater level. And then they feel less than dazzled by what a plan would look like at that low premium amount. Now, don't get me wrong. If you have major budget constraints, of course, starting with whatever you can, whatever fits your budget, whatever amount that is, it's okay. It will work. It will still be better than doing nothing. It will still be something you'll love. It's just that if you have the means to fund well and choose not to, then I think really you'll be kicking yourself later for not having funded at a higher level. And also you have to keep in mind when you are talking to someone and looking over an illustration that that's just one piece of the story, because when you have a banking system, it's more than just that one illustration. Inside of one illustration, we are going to have to drop the premium at some future point, because if you overfund it for too long, you will mech the contract and it will become taxable. Now, certainly Nelson Nash was not shrinking his premium dollars. He was increasing them. And then he'd have to do that by opening up another policy, because you cannot increase the premium in your existing policy once you've already set that premium. So looking at one illustration isn't going to really tell you the whole story of what could be with your banking system. It could certainly be way more amazing than what you're looking at within one illustration. If you think about it, if you had your own bank, how much of your money would you run through your own bank? How much of your money would you house in your own bank? Would you put very little money into your own bank and then the rest of the money in someone else's bank? Probably not. You're probably going to house and put the majority of your money in your own bank. And so that's why when you're thinking about a contract, you should be thinking about running as much of your funds as possible through your own banking system. I was talking to a client the other day who just needed a little refresher, and I used this example, which I think could be helpful. I told her, imagine building a large enough pool of cash that you would be able to finance a rental property from your own system. Your guaranteed interest rate would be 4%, and you would be in complete control of that loan. It wouldn't show up on your credit report at all, and you would be able to access that money without any application or credit check or anything like that. If you did this and then something ended up happening where you were unable to get renters for a year in your new rental property, and you didn't have the excess cash to pay the mortgage for that year, since it's from your own system, you could simply choose to stop repaying yourself for the year. This is absolutely unheard of with any other type of loan. And meanwhile, your full cash value would continue to earn the guaranteed interest rate and dividends from the insurance company as though you had never touched the money. So I think that that's a really good example and explanation, although of course we're always going to tell you to pay yourself back with interest, not just take the whole year off, but it is a possibility because there is so much flexibility within a plan like this. So I hope this was helpful. I hope this was interesting. I hope that if you're reading the book or that you get a hold of it and maybe read the story, it's going to be a lot more interesting reading it from the book. But if you'd like to connect and like to start looking into a plan for yourself, feel free to reach out to me at Valerie@alphaomegawealth.com. Thank you so much again for listening. I hope you have a super great week. Take care.
This is the podcastfactory.com.